We're kicking off today's deep dive with the headline earnings report of the morning. Goldman Sachs coming in ahead of Wall Street expectations, driven by strength in trading revenue at a moment when markets are already on edge. This is not a trivial beat in a calm environment. Equities are under real pressure right now, with the S&P 500 off 0.7% and the Nasdaq 100 sliding 1.90% as the Nasdaq declines. Meanwhile, the 10-year Treasury yield has surged to 4.61%, up 88 basis points on the session. A macro backdrop that makes Goldman's outperformance all the more telling about where institutional capital markets activity is running right now. Goldman Sachs reported second-quarter results that cleared analyst consensus estimates, with the primary engine of the beat sitting squarely inside the trading division. Both fixed income, currencies, and commodities, known as FICC, and equities execution. This is the part of the bank that directly monetizes market volatility and client activity levels. The timing is significant. The VIX is sitting at 1739 this morning, up 1.34% on the session, which tells you volatility has been elevated enough to generate meaningful bid-ask spreads and client hedging flow. A beat in this environment means Goldman's traders actively captured that activity, rather than letting it pass to competitors like JPMorgan or Morgan Stanley. The deeper macro story here is what a 4.61% 10-year yield does to a firm like Goldman Sachs. Higher rates compress multiples in tech and growth equities, hence the Nasdaq 100's 1.90% drop this morning. But they expand the revenue opportunity for fixed income trading desks enormously. When the yield curve steepens, with the 5-year at 4.36% and the 10-year at 4.61%, institutional clients need to reposition duration exposure constantly. And Goldman sits in the middle of every one of those trades as principal or agent. That client activity generates flow, spread income, and positioning gains that show up directly in FICC revenue, the single line item that drove this beat. The most direct beneficiary is Goldman itself, with the stock likely to outperform the broad financial sector on this print. The Financial Sector Financials ETF is the second-order red. A validated Goldman beat confirms that capital markets activity across the sector was robust, lifting sentiment for JPMorgan, Morgan Stanley, and Bank of America as they approach their own releases. Critically, this beat does not resolve the tension in tech. The Nasdaq 100 is down 1.90% because rates at 4.61% on the 10-year reprice, long-duration growth cash flows lower. Goldman's strength is a financial story, not a broad equity stabilizer. The S&P 500 sits near current levels, and the S&P 500 is still off 0.7%, suggesting the lift from financials is not yet broad enough to reverse the morning's risk-off tone. Three catalysts deserve close attention from here. First, the 10-year yield at 4.61%. This is the fulcrum. If yields continue climbing, financials benefit further. But equity multiples compress, and the tug-of-war between the financial sector strength and the Nasdaq 100 weakness intensifies. Second, watch peer earnings from JPMorgan, Morgan Stanley, and Bank of America to confirm whether this is a Goldman-specific execution story or a sector-wide capital markets tailwind. Third, monitor the VIX, currently 17.39 and rising 1.34%. A sustained move to elevated levels would shift the narrative from constructive volatility to outright risk-off, potentially reversing even the financial sector bid as credit spreads widen and institutional clients pull back from new positioning. Goldman Sachs beating on trading revenue with the 10-year yield at 4.61% is the cleanest possible confirmation that the capital markets business thrives in a higher rate, higher volatility regime. The financial sector trade is alive, and Goldman Sachs likely leads the financial sector higher today. But the broader equity market is not out of the woods. The S&P 500 at 0.7% and the Nasdaq 100 at 1.90% tell you that the same rate environment rewarding Goldman's trading desk is punishing growth equity valuations everywhere else. The story that matters for the rest of the week is whether peer bank earnings confirm Goldman's strength or reveal it as an outlier. That answer shapes whether financials can hold the tape together as yields stay elevated. That is the one story that matters in earnings season today. Full breakdown is covered. If you found this breakdown useful, hit subscribe and tap the notification bell so you never miss a deep dive market recap. Every trading day, we break down the stories moving your portfolio with the specific numbers and analysis you need to stay ahead.